Hi there, class. Welcome to the next video for Finance 6300. If you haven't watched the videos up to this point, I recommend that you go back and check them out. We'll be building on those concepts in this video. Here's what we're going to cover in this video. We'll recap the course to this point, then I'll introduce you to what I call the entrepreneur's journey, and ultimately the key for when to sell your stock. As you all know, the hallmark of a good course is the instructor's effective use of Dilbert. Not wanting to fall short, here's the Dilbert for this video. The boss says, "I'm getting reports that you're being arrogant in meetings." Dilbert replies, "That's because I have a deep understanding of technology and a moral obligation to keep simpletons from ruining the world. Maybe you could tone it down a little. There's no kill switch on awesome." So, speaking of technology, let's do a quick recap of the last video. We've talked about the idea that technology is an idea plus execution, and that coming up with a better way of doing things is the miracle that we call technology. Under this definition, all companies are tech companies. We reviewed the history of equity financing and publicly traded stock, which, while the most technologically advanced method for financing companies, is too costly and onerous for young startup companies to do most of the time. That led us to methods for selling shares of stock in private companies and the backdrop of venture capital. Ultimately, we arrived at the big question: how do we value our private shares? We covered three methods for valuation, and income, asset, and market approach, and how most valuation approaches for startups use the market approach. For the market approach, we need to know what the going rate for our type of company shares is, and that means we need comparables. In valuation terms, an industry average multiple gives us a way to approximate value based on certain key metrics like revenue or earnings. And I gave you our basic multiples for revenue and earnings based on private and public company valuations. So this starts to give us a ballpark for what the company is worth. But some questions remain for both the entrepreneur and for the investor. How much equity should I give up? How much equity do I need to get my return? And that led us to this, the valuation formula, which we covered in the previous video, so I won't do that here. That completes our recap. In order to add context to these ideas, let's walk through the steps of creating a startup and growing it. I call this the entrepreneur's journey. Remember that the business starts with a spark of inspiration. In fact, here's a little clip from the Croods to help you remember this.
How do I get across? I gotta think. What would Guy do? What would Guy do? What would Guy do? What would I do? Hold this. I have an idea!
Just like Grug, you came up with an idea, and Nuco was born. But remember, we need an idea and execution. So now what do we do? There are lots of questions to be answered and decisions to be made. To underscore this, I've got one more video for you. I'm turning again to our friends, the cast of HBO's Silicon Valley.
Thanks for coming in, guys.
We have a lot to do, so let's get started.
Sounds great. Me? Okay. Well, we're just really excited to get going, Mr. Gregory.
Yes. Who's we?
Myself, him, the guys back at the house.
Guys? What guys? Who is this?
Erlich Bachman. I'm an entrepreneur, much like yourself. Richard actually developed Pied Piper while residing in my incubator, so as per our agreement, I own 10% of the company.
I'm paying you $200,000 for 5%, yet you're giving this man twice that in exchange for a futon and some sandwiches?
Actually, sir, my tenants provide their own food and...
What other percentages have you apportioned? Can I see your cap table, investment deck, business plan, or any other relevant paperwork you may have prepared?
I just was under the impression that we would just be coming by and saying hi, you know, to pick up the check. And I just didn't know that any of that stuff was due yet.
Due? This is not college, Richard. I'm not going to be giving you a course syllabus. You turned down $10 million to keep Pied Piper. What did you give up that money for? What is this company? What did I buy?
You bought the algorithm, which...
No! The algorithm is the product of the company. I know that. What I'm asking about is the company itself. Who is it? What do they do? Are they essential? Or do you just throw a percentage at them like you did with this? This all must be worked out now.
When you said you'd guide us through some of the stuff, I thought that this was the stuff you'd be guiding us through.
I cannot guide you until you give me something to guide. This is going very poorly.
I know.
He doesn't seem to know what he's doing. Did you just take a sip from an empty cup?
Yes.
Why did you do that?
Just something to do.
Come back in 48 hours with an airtight business plan, a clear go-to-market strategy, and a 3-year summary P&L, or there will be no check. That's it.
Thanks for coming in, guys.
Are there any water fountains in your offices?
I assume.
I own 10% of an app that locates all nearby water fountains. I'd be happy to discuss it with you once.
Good day, gentlemen.
So, not having your act together, not a great way to impress the VC. Decisions. To start with, our business is going to need a legal formation and a place to live. We call that a domicile. Let's look at formation first. We could run our business as a sole proprietorship. The cool thing about sole proprietorships is that you don't have to do anything. You already are one. But there are some downsides to this. The biggest one is that there's no separation between you and your business. That means that if your business incurs any liability, and it's super common for businesses to incur more liability than any single person, then you have personal and unseverable liability for any and everything that your business is liable for. Something goes wrong with your business, people show up to take your house and your car. Well, that's kind of a downer. So what about a partnership? In a partnership, you get to pool resources with a partner or partners. It's nice that way you don't have to come up with all the money to start your business. But unfortunately, this does nothing, zero, to decrease your liability. In fact, it actually goes up because your liability is inseparable from your partner's. If your partner does something wrong, you're both on the hook for it. If they do something wrong and they can't afford to fix it, they're coming after you. Again, you lose your house, your car's life is not good. Now, limited partnerships can mitigate this a little bit, but there are some drawbacks there too. We'll talk about that. A lot of times venture funds are organized as limited partnerships, or at least parts of them are. We'll cover that more in a later video. What about a straight up corporation? Corporations are separate legal entities. If your corporation gets sued, its liability ends with the assets of the corporation. That's nice. You're not on the hook personally for anything that it does, and that's pretty awesome. The downside to corporations is how they approach taxes. So let's say your corporation earns $1 million. That $1 million gets taxed at the corporate tax rate. Let's say 35%. So 35% of the $1 million gets paid in taxes. So you now have $650,000 that's left, but that's not right. You don't have $650,000, the corporation does. So if you want to get any of that money, you're going to have to write yourself a check or pay yourself a salary from the corporation. But now that amount gets taxed as ordinary income to you. So you pay another 25% tax on the money that you get to take home. So depending on your tax bracket, that means that this $1 million income after taxes ends up being somewhere around $490K. You lost about half of it in taxes. So that's kind of a bummer. That's called double taxation, and it's a downside to starting with a corporation. What about an S-Corp? An S corp isn't actually a different kind of business. It's still a corporation, but it's filing its taxes using the S corp rules, which protect against double taxation as long as you meet certain rules. Now, those rules can get kind of sticky when you go to raise money. So you need to know about this, right? You might think, oh, hey, I'm going to do a corporation. I'm going to do an S corp so that I don't have double taxation. And then you go out to raise money and you break one of the rules and all of a sudden your S corp status goes away. For example, you can't have any investors that are other corporations, partnerships, or LLCs. That means no VC money could go into your S corp because they're going to invest from a fund that is a company. You can't have foreign investors, so you can't have anybody that's investing from outside the country. You can't have multiple classes of stock, so you can't have common and preferred or Series A or Series B. You just have to have one class of stock, and that's common. You can't have more than 100 investors. So if you're crowdfunding or you're sourcing investment from angels and they have a syndicate and it gets more than 100 investors, your S corp goes away. And so what happens if you break one of these rules? Well, at tax time, you get treated as a regular corporation and lose the S corp advantages, and you're back into a double taxation situation. So what can you create that doesn't result in huge taxation, that gives you the flexibility to what you need to do? That's where LLCs come in. Limited liability companies have many of the benefits of corporations, but avoid double taxation. Now, corporations still may be better if you go public because people are used to trading corporate shares rather than membership units of an LLC. But that's not because you can't go public as an LLC. You can. It's just more familiar to investors, and sometimes that familiarity can be the difference between getting investors or not. So there's just more familiarity with corporations and a longer history. I usually recommend that you create an LLC first and then make the decision about converting to a corporation later as your circumstances dictate. It's generally pretty simple to convert an LLC into a C corp. So it's not something that if you start as an LLC, you're done. If you don't, you can't ever change it. You can. So what about the next question? And that is domicile. You may have done business with a company domiciled in Delaware, right? You may have seen companies domiciled in Delaware. Probably all of your cell phone agreements and cable subscriptions, if you still do that, are all those agreements are written up as contracts with companies in Delaware. So why is Delaware so popular? Over 50% of all publicly traded companies and over 60% of the Fortune 500 are registered in Delaware. A huge swath of Delaware corporations are international businesses. So if you're an international company, you want to domicile a company in the US, it's very likely you're doing it in Delaware. So why? What's so great about Delaware? Well, there's two reasons: taxes and business law precedent. So Delaware has a favorable tax situation, but perhaps even more important than the tax situation is that Delaware has a super long track record of adjudicating business disputes and issues of business law. So in business, uncertainty is like the worst thing you can have. You can't plan, you can't forecast, you can't execute if you have uncertainty. So knowing how business disputes will come down creates a huge benefit for corporations, and that's a big reason why they domicile in Delaware. It's really about predictability. If we get sued, if we have some kind of legal issue, can we reasonably predict how the outcome will go? And in Delaware, they have a better shot at that. So what about LLCs and other states? Well, Nevada used to be a good choice, but now it's pretty expensive and kind of onerous. Like Nevada's kind of lost its shine as a good state to form your LLC. So you might want to consider how likely it is that you would have to travel to defend lawsuits, the overall costs of registering a company, what the Secretary of State or Department of Corporations have to say about what it costs to register your company, etc. And depending on the state, some states have laws that make it more or less difficult to do that ultimate conversion to a C corp if you need to. With the rare exception, you should choose either a corporation or an LLC to start your business. They're by far and away the advantages for startup companies rest with those two forms. Okay. So we picked a form, maybe we've got a new LLC, we're going to domicile it in Utah right now because that's where we live and it's going to be easy, but we know that we can always re-domicile it in Delaware and create a C Corp if we need to. So now that we found this company, how do we fund it? How do we fund NewCo to actually start operations? And remember, always keep in mind the first rule of finance, which is to never run out of cash. See the little test question pencil in the bottom? Never run out of cash, the first rule of finance. Well, there's some options out there for how we get our funding. We could bootstrap it. This is essentially self-funding. This is from the old saying about pull yourself up by your bootstraps, which was an old saw meaning tackle your challenges without external help. So companies that went their way in the early days without outside funding are said to have bootstrapped their way up to the point that they got funding. Bootstrapping includes using your own funds. It includes using credit cards, sweat equity, taking out personal loans against assets that you own yourself, like your home, your car, or money you might win, like in a pitch or business model competition, or grants that you might qualify for. So all of those things would qualify as bootstrapping. Now, what about options outside yourself? Well, crowdfunding is an option. In 2012, Congress passed the Jobs Act, which outlined new rules for companies to raise funds. And then in late 2015, those rules were finally written and published by the SEC. If you meet the criteria for crowdfunding, this is an avenue that is now open to you. There are some complexities with crowdfunding. So if you decide that this is something you want to do, I encourage you to become familiar with what the rules are. You can find family members or friends to help you. Personally, I think more angel investing happens this way than just about any other way. In the industry, this is sometimes referred to as family, friends, and fools, because typically your company is much too early to have any certainty of success. You can find angels, who are so named because they're seen as gifts from heaven, right? Investors who would take a risk on your company when nobody in their right mind would. You can raise money from wealthy people or high net worth individuals. The SEC has a special criteria for when someone is called accredited, which generally means that they have made over $200,000 per year for at least 2 years running and expect to continue to do so. If it's between the investor and his or her spouse, then the amount is raised to $300,000 that they can earn together to be accredited, or individuals with a net worth over $1 million, excluding the value of their primary residence. Those are the basic criteria for being an accredited investor. There's some other rules if you're a company, but those are the ones you should know. Basically, the SEC views these people as able to make decisions that could result in them losing their money. So there's a counter argument to that, where some people say that this rule makes it to where only the rich get access to the best deals. There's probably some truth to both. Sometimes angels get together and form networks, like the Park City Angels or the Utah Angels locally. This is a way that they combine their resources and review potential investments. Sometimes it's a lot easier for them to be screening investments together than it is apart. Another way companies access accredited investors is through third-party broker-dealers who act as registered investment advisors. Of course, venture capital is an option, including the ever-growing number of corporate VCs. These are venture investors that are formed as an investment arm of a company. For example, Google has Google Ventures, Intel has Intel Capital, Salesforce.com has Salesforce Ventures, etc. In 2016, there were about 200 active corporate VCs in the country. We could go to traditional banks or look for SBA loans. These are channels for raising money via debt rather than equity. They typically have heavy collateral requirements, so startups with not very many assets, which includes most of them, often struggle to get loans or SBA financing. But if you have the right assets, this could be an option for you. And debt's not always a bad option for companies, depending on their model. There's a growing number of what's called venture debt deals getting done, and these are essentially venture investors who are making loans instead of equity investments. And then there are some more startup-friendly options, like companies like OnDeck that make essentially payday loans to startups. The terms are actually not as egregious as payday loans, but they're high-interest, short-term loans that are business to business. There's also something called family offices. So family offices are money management arms who invest on behalf of wealthy families. They can be significant across the spectrum of investing. Institutional investors are companies or funds whose purpose is to invest. So technically VCs would qualify as institutional investors, but here we're typically looking at real estate investment trusts, pension plans, insurance companies, etc. There's private equity firms. So again, venture capital is technically a subset of private equity, since both of these types of investors focus on equity investments in private companies rather than public ones. But traditional private equity looks to capitalize on undervalued companies. That's often companies that are more mature than startups, but have fallen on hard times or are struggling. And so private equity in the traditional sense is focused on a different type of investment than venture capital. Hedge funds invest in both private and public equity. They typically have a particular strategy for investing that leverages specialized information technology or processes. And you could do an IPO. You could go public. We spoke last week about how this is particularly hard for startups. So that may not be a good option for NewCo. You could court investment outside the country, which would typically fall into one of the same categories we mentioned, but it would include the international complexity of putting a deal together across national borders. Now, each of these funding sources has its niches. They're focused on companies of a certain size and type and stage. But with this view of the basics of valuation and the potential sources of funding, let me ask another question. Let's say we have determined that the company is valued at $50,000 or $500,000 or $5 million, and an investor needs to own 30% to get a good return. Is the same investor going to look at all three deals, at all three valuations? And the answer is no. It's super unlikely. Investors have varying tolerance for risk, exit horizons, investment amount, desired returns. So this slide from a Gartner presentation shows the various investors and where they might line up with the company's growth stage. I like to think of this as rungs on the ladder, and what you need to do is find an investor that matches where you are in your company's growth, the amount of money you need to raise, etc. As your company matures, it moves up the ladder. Over the life of your company, you'll likely raise multiple rounds of financing, and that could require that you court investors at early stages who have the best option for making follow-on investments that you'll need in the next stage. Or maybe they just need to be the ones who introduce you to the investors that you'll need in the next round. Here's a look at rule of thumb for various investors. As a founder, right, you're putting in money into your company. Maybe it's only a tiny amount of capital, or maybe it's only sweat equity, but you should look at yourself as an investor, that a company will start with the founder round or the bootstrap round. So even if it wasn't much, even if it was just your time to get the company started, you got to put some money in. And founders are typically looking to work on their business for a period of 5 to 10 years. What about angels? Well, angels can be anywhere from $50,000 to $100,000 on the low end to several $100,000. A good deal for them typically generates 25 to 100% returns, and they're usually looking to exit in 2 to 5 years. There's a crossover category here where the bigger angels and the smaller VCs operate. These deals behave more like VC deals, but the investment amounts are typically smaller. VCs themselves often focus on deals of a certain size and company stage. A Series A deal might range anywhere from $1 to $10 million. The series letter really just refers to the order in which investments are made. A comes before B, etc. As A investments got bigger, angels and seed investors started calling themselves something different. They stopped saying, okay, we're the A round. And so in order to not bias future investors against the company for taking a really small A round when it was really just their seed capital, this is typical now for a company looking at what's called an A round. There's no actual tie or no actual rule that says an A round has to be a certain size. It's just what is customary. There have been so-called jumbo Series A deals, like 60 to 200 million, but these are super rare and not the norm. Also, you might have a VC that specializes in advising companies that are raising their first bigger money. Typically, seed money allows the startup to test out whether it can get initial traction, generate some interest from customers that's sufficient to build a sizable company around. It's like proving money. Is the business really going to work? And then Series A is often about solidifying your product market fit and getting the company in a position where it can actually scale and ramp up. Now, likewise, there's a typical range for a Series B focused VC. The investor may be focused on the work it takes for a company to experience hypergrowth, like that investor is all about scaling companies up, or it may be an investor that focuses on laying the groundwork for the company to do an IPO. And then there's investors in the IPO, and they're looking for certain things. Note that the amount of the investment is higher, but the expected return is actually lower. And that's because the company has matured and become less risky. So since the deal has less risk, we know that public equity has high liquidity. That means that the returns can likewise be lower. In evaluating what's right for your company, you need to kind of consider the tolerance for risk, consider the length of time of the investors typically expecting to be in the investment, and what kind of return they're looking for. That way you can design your capital structure to deliver what investors need and make your deal a more attractive option. People often speak about a match between founders and investors in terms of personality or company or industry, but you also need to find a match in terms of just the basic investment criteria, the basic economics. So in order to look at this a little closer, let's walk through this fictitious company. We just formed NewCo, right? We just formed NewCo. It's an LLC domiciled in Utah, and let's look at its journey. So we'll chart the company with this graph. The valuation will be on the top half and the equity will be on the bottom half. The financing round and price per share will be on the bar in the middle. Now, bootstrap will be our first round. This isn't really a round of financing like we talked about before. This represents the founder investment. So we'll use that term to describe what the founder does before taking money from anybody outside. In this case, you put in $10,000 as founding capital, and you issue yourself 2.9 million shares of stock. You're like a stock millionaire now. This is awesome. So why 2.9 million shares? That will become obvious as we go through the process. But what you're doing is you're looking at the end and from the beginning, and you're trying to anticipate how your company's capital structure is going to need to be. So it's not just arbitrary. Now, if we look at that, $10,000 divided by 2.9 million shares means that your shares are worth 0.3 of a penny per share. Now, that price really is only descriptive at this stage. Whether it's fair, whether that's a fair price for the company at this level, it's just too early to say. But the number of shares issued is intentionally looking at the end from the beginning, and keep that in mind as we go through the next stages. That puts the company's value at its total assets, or $10,000, and its capital stack is 2 million shares, and they're all owned by you. Then you meet an angel. This could be your rich uncle or your grandmother or someone you met. Grandma's not taking a super serious look at your company because there isn't a lot to see yet. What she is doing is expressing her faith in you as the founder. Grandma puts in $100,000 and you sell her 100,000 shares. Note that the company is issuing new stock for each round, so you're not selling Grandma any of your original shares. With $100,000 with 100,000 shares, that puts the price per share at $1, which means you now have a basis for valuing the company at $3 million. Number of shares times the price of the total stock, including the last issuance. That's the company's market cap. That's its value. Is the company really worth that much? Well, maybe. Ultimately, valuation is trying to get at the price somebody is willing to pay, and you had one buyer who paid $1 per share. It's questionable how many buyers you would have at that rate, but you legitimately sold stock at a $3 million valuation, and there are now 3 million shares issued and outstanding. You take the $100K from Grandma, you go to work building the business and increasing its value. Note that each round of financing should not be viewed as adding value to the company, but only realizing value the company has added since the previous round. So we want to look at financings as value recognizing events, not value creating events. As you get ready to raise another round, you realize that you may need to set aside an option pool to use for recruiting your superstar senior management team. You probably can't pay them top dollar yet, and you need them committed to the company. So for the next round, you set aside 350,000 shares for your employee option purchase plan. Note that this isn't a sale of stock, it's merely a reservation. So we track the number of shares as if these options were exercised, even though they aren't yet. So this is what's called your fully diluted capital stack. It's as if everything that could turn into stock has. What does that look like? Likewise, no money changed hands, so there's no change in valuation here. Now, next, you raise your seed round. You're going to raise $1 million for your seed round. You sell 800,000 shares, so the price per share is $1.25. We now have 4,150,000 shares of stock fully diluted at $1.25 per share. That puts our company valuation by market cap, shares times price, at $5,187,500. So let me ask you a question. Is Grandma happy about this seed round? Well, sure. Her $100,000 investment is now worth $125,000. Plus, she's no longer alone as the only one you've been able to convince that your company is worth investing in. She always knew you had it in you, but the validation is nice too. You take the seed money, put it to work building the business, you're getting traction with customers and they're loving your product, you're getting this business figured out. But your growth is hindered because you can't hire the salespeople fast enough on your current cash flow. Time to raise more money. You go out and raise an additional $5 million in a Series A from a VC who focuses on that stage. For the $5 million, you issue 2.5 million shares of stock. In this case, the VC has asked for preferred stock with certain special rights, but ultimately those preferred shares will turn into common shares, so we won't worry about those details right now. Those numbers mean we raised our A round at $2 per share. That means we now have 6,650,000 shares and a valuation of $13.3 million. So let me ask you again, is Grandma happy? Well, sure, her $100,000 investment is now worth $200,000. Well, what about the seed investor? The seed investor is also happy. Their $1 million investment is now worth $1.6 million. Looks like everybody has a lot of reason to be happy. You go back, work on building the company. You're ready to scale this thing big, and you have your eye on an eventual IPO. You're going to need to raise more money to really scale to your full potential. So after working on this company for a period of time, you go out looking for a Series B. And you get it. You raise an additional $17.5 million in a Series B. The Series A investor had some pro rata rights, which allowed them to participate in the Series B. The Series B investor does the lion's share, and combined, you issue 3.5 million shares of stock. That puts your price per share now at $5. You've now got 10,150,000 shares out there and a valuation of over $50 million. Going back to the same question, are all the previous investors happy? Well, Grandma's $100,000 investment, she invested at $1 per share. She has 100,000 shares. Now at $5 a share, that means her $100,000 is now worth $500,000. The seed investor's $1 million is now worth $4 million. And the Series A VC's investment of $5 million is now worth $12.5 million. Looks like everybody is happy. Now, hold on a second, you say. With each new round, the previous investors are getting diluted. And isn't dilution bad? And that's true, right? Each new round, we're issuing new stock, which means the percentage of the company that's owned by previous investors goes down. That's called dilution. So isn't dilution bad? Well, that's a great point. What we're seeing here is numerical dilution. It's numerically dilutive to add these rounds of investment. When the Series A investor bought 2.5 million shares, that represented about 38% of the company, right? See that? If I take 2.5 million shares divided by the total number of shares at that round, which was 6,650,000, that gets me to 38%. After the Series B investment, those shares only represent a little less than 25%. So isn't that bad for the Series A investor? Aren't they going to be upset? Well, this example is illustrating how successive rounds of financing, while numerically dilutive, represent an accretive valuation. Accretive is a word that means to lay down in layers. In this sense, the value is accretive because even though each investor owns less percentage-wise of the entire company, the value of their investment is going up. Ultimately, these investors are looking for returns, so the numerical dilution is acceptable in order to capture the accretive valuation. Okay, so you've taken the Series B investment, scaled the company up. It's really something now. And as you look back on your initial $10,000 cash outlay, you're kind of surprised you've been able to take it this far. Looking pretty awesome. You are ready to do an IPO. So you priced your IPO at $13 per share. A typical IPO is priced at $11 to $13. A really hot IPO might be priced at like $16 to $20. But you planned your capital stack so that you could be very happy at a normal price range. You knew ahead of time that going public would require a certain valuation and a certain number of shares in the public float. So you issued 5.5 million shares in your IPO at $13 per share. That brings your total shares to 15,650,000. At this point, your IPO value is so big we can't even show it on the slide. So let's adjust our scale a little bit here. There we go. Your valuation is now $203,450,000. How much is each investor along the way worth now? Well, the public investors own 35.1% of your company at $71.5 million. The Series B investors own 22.4% at $45.5 million. Remember, they put in $17.5 million to start, so they're going to be feeling pretty happy. The Series A investors, right, they now own 16% at $32.5 million. They originally only put in $5 million. Your seed investors, they still own 5.1% of the company, and their value is worth $10.4 million. Remember, they only invested $1 million. Your employees, we set aside options in our employee purchase plan. And so now those options represent 2.2% of the company, and there's $4.5 million worth of value there distributed among those early employees for their loyalty and work. Grandma only owns a measly 0.6% of the company, but that 0.6% is worth $1.3 million on an investment of only $100K. And what about you? You're the founder. You went from owning 100% of the company to only owning 18.5%, less than a fifth. But that 18.5% is worth $37.7 million. Pretty nice increase over your $10,000 initial investment. But remember, you also put in 5 to 10 years of your life to build this company. Now, is everybody happy? Well, they ought to be. These are outstanding returns for everybody. You built an accretive capital structure, and this is how each party in the deal of growing the company from its bootstrap stage to IPO, each contributed and benefited from growing the company and the shift in value as the company grew to be worthy to go from a private company to a public one. Back to our agenda, we recapped the previous videos and we've gone through what we call the entrepreneur's journey. So now you've got a model for how the company goes from inception all the way through to IPO. Now Newco is public and you have a way to get liquid through the public markets for your stock. So the next big question is, when should you sell your stock? This is actually really tough for investors. In fact, probably the toughest question for all investors is knowing when to sell. Let's take a look at some of the issues. Well, to begin with, you can't sell right away. What? Seriously? Yep, that's right. You can't do it. Founder stock is subject to a lockup agreement. This is to prevent people from doing an IPO and then dumping all their stock on the market, which effectively hoses all the investors who only got a chance to invest in the IPO. The lockup period is typically 180 days from IPO. So after you IPO, you've got 6 months to wait before you can sell your stock. Now, this lockup period can create what's called overhang. Overhang is essentially cheap stock, and it threatens to flood into the market in a rush. So understanding the basic economics of supply and demand, if supply is suddenly dramatically increased above demand, what happens to price? That's right, it falls. It drops, and that's bad for the company. After an IPO, the company's ability to raise additional money and to be seen as healthy is often a factor of the price and volume of its stock. Remember that. The ability of a company to continue to raise money after an IPO is a function of the price and volume of its stock. Now, a perfect example of how a lockup period can catch a company off guard is LinkedIn. Here's a chart of LinkedIn stock from the time of their IPO through most of the first year of trading. LinkedIn went public at $45 per share on May 19th, 2011. By the next day, the stock had more than doubled in value at $94.25 per share, placing LinkedIn with a value of over $9 billion. Not bad. Over the next 6 months, they rode the market's ups and downs, hovering fairly consistently around $80 per share. Then, predictably, in November, 6 months after the IPO, LinkedIn's shares take a slide to below $60 per share. That's the lowest point since their IPO. And they wouldn't recover that loss in volume until the following year. So think about it. The company lost 25% of its value almost overnight. How come? Well, because the executive team didn't manage their overhang. Early shareholders, mostly employees, sold their stock immediately as soon as they were able to. The spike in volume was bigger than demand and the price fell. So is this something that nobody could do anything about? Like what could LinkedIn have done? Well, they could have identified shareholders likely to sell and either found ways to stagger them or found buyers for the extra supply of stock hitting the market. Remember this, only one thing is required for your stock price to go up, and that is you need more buyers than sellers at the end of every day. If you have more people buying than you have selling at the end of every day, your stock price continues to go up. So if LinkedIn had found buyers to outpace the sellers, then they could have managed this overhang getting into the float. So when is the best time to sell? Well, let's look at an example and do a little easy analysis. Here we have earnings per share projections for Newco going out 5 years. From these projections, we can estimate the growth rate. Here we see the compound annual growth rate, or growth rate compared to the previous year. It starts pretty high, but over time, as earnings continue to grow, the rate of growth settles into kind of a more stable pattern. Next, we'll look at earnings per share. We used our rule of thumb of 20 times trailing earnings, and we capped the PE ratio at 40. Do you see how the growth rate and the PE ratio start to converge? Well, that's a sign that the company is becoming fair valued. In other words, investors are paying a reasonable price based on the earnings the company is producing and the rate at which those earnings are growing. Next, we'll estimate the price per share. If we track the high side of the price per share, we can see here that the most profitable time to sell is right there. Here in year 3 at $100 per share. That gives you an idealized structure from inception, the very beginning, through successive and accretive rounds of financing to an eventual exit at the best price. Investors harvest their returns at exit. Companies only have 4 potential exits. The company may pay dividends or throw off cash from operations. This is the kind of business that's sometimes referred to as a lifestyle business, so-called because it generates enough money, perhaps several $millions a year of profit, which is enough for the founders or the senior management to live comfortable and have a comfortable lifestyle. But the company is not destined to be large. It's not going to be anything huge. The founders may intentionally not want it to be large, or they may want to remain serving a niche market. There's also mergers and acquisitions. When a company sells, the shareholders harvest their returns in the sale. As I mentioned, the company could do an IPO and sell their shares in the public markets. After an IPO, investors and founders have a public market to sell their stock and capture returns. And there's always the option that the company could fail. It could crash and burn. If the company fails, investors effectively walk away from their investment and the returns are zero. Not only do they have zero return, but they take a loss. Now, only 2 of these are really acceptable for VCs. Founders sometimes make the mistake of thinking that a lifestyle business is a good business for VCs, but without huge growth, the business doesn't have the ability to generate the returns that VCs are really looking for. And that's it for this video. Remember that potential test questions are marked with that little pencil icon, and we will see you on the next video.